My name's Crystal, and my husband and I are the owners of First String Bookkeeping Co. If you are like so many other business owners, then you probably find tax time incredibly overwhelming. Between the stress of knowing that you're likely going to have to give more of your hard-earned money away, trying to find all the right documents, then trying to understand the lingo of your accountant, and finish it all off with paperwork that's so hard to understand it feels like you're reading a foreign language. It's no wonder most people dread tax time. But have you ever thought maybe it doesn't have to be this way? Our goal at First String Bookkeeping Co. is to help you feel more confident when it comes to your business's finances. So whether you're hoping to just be able to understand your numbers a little bit better, or ultimately you'd love to be able to do your books yourself, I think you'll find these videos very helpful. So let's kick it off today by talking about one of the three main reports that you should be looking at as a business owner, which is the income statement. It's also known as the profit and loss report, or P&L for short. Now, I'm sure most of you are probably already familiar with this report, so you might be wondering, why are we starting so basic? But I did it intentionally because I want to make sure that everyone watching these videos has a really good foundation and there aren't any big gaps. So I hope you'll bear with me because we will get into more complex topics in future videos. So the income statement is a report that shows you the revenue coming into your business. So that's the money that your business is making from either the services you provide or the goods that you sell. Then it shows you your business expenses, which are the reasonable costs incurred to run your business and earn that revenue. And it finishes off by showing you whether you had a net profit or a net loss. So a net profit happens when you have more revenue coming into the business than you have expenses going out. And that's where you want to be because let's face it, you're in business to make money. You don't want to have a net loss, which is where there's more expenses going out than money coming in. I would recommend, and I'm sure all of my bookkeeper and accountant friends would agree, that you should be looking at this report on a monthly basis. Please do not wait until tax time to look at your numbers. If you're not making enough money in a certain area or your costs are too high in another, you need to be able to make adjustments much more frequently than once a year. You can generate this report for really any accounting period that you would like, 1 month, 6 months, 12 months, or any other number between those that I didn't mention. The only caveat is that it's not typically pulled up for anything more than a 12-month period at a time. But if you want to see a year-to-year comparison or even a quarter-to-quarter comparison, make sure you also check out the comparative income statement. That report is super, super helpful to show you the health of your business, and you'll be able to see whether your business is growing or not. So that's the income statement in a nutshell. I hope you found this useful and that you'll join me next time. We'll be talking about the statement of owner's equity. See you then.